We've all experienced a synchronized slowdown in traffic, but what about a synchronized slowdown of the global economy? Well, buckle up. Why? Because a growing number of economists are saying that's exactly what's going to happen. What could it mean for our economy? And most importantly, for your retirement savings? Yes, it's that time again. Time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. You know, I've talked about the global financial markets on this show quite often, and the fact that international economies are more interconnected today than ever before. And that's why slowing growth and shaky financial markets here in the United States, as well as some of the other major economies, now have many people pointing to a synchronized slowdown and possible recession for almost the entire global economy. Heads of the World Bank and International Monetary Fund recently delivered fresh warnings that include this blunt statement. The global economy is now in a synchronized slowdown. Now, does that mean a global recession is inevitable, or can it still be avoided? What forces are causing the slowdown and the synchronization? What might this mean for the U.S. economy and financial markets specifically? Finally, is the U.S. prepared to handle another potential Great Recession, or even a minor one? We'll tackle those questions and more right here on today's show. And joining us today will be Sam McElroy, partner with At Financial and At Financial Investments in Chicago, Illinois, along with Michael Eastham, founder of Fellowship Financial Group in Altamont Springs, Florida. Plus, Newsmax TV's John Bachman will join us to give us the latest news on the global economy. But first, let's look at some of the major forces behind this synchronized slowdown. You know, we've talked a lot on this show about the increase in the warning signs of a U.S. recession, from shrinking GDP growth to the interest rate yield curve, which still remains partially flat after being inverted for a good part of the summer. With trade, borrowing, investing, and other forces tying major global economies together, it's understandable why our own economic fate would have major ripple effects around the world. What makes the situation worse is that many of the world's other top economies are experiencing major slowdowns on their own, as well as, in many cases, their own market turmoil. Japan is facing another recession and is locked in a nasty trade dispute with South Korea, while the UK's economy is shrinking thanks largely to ongoing turmoil over Brexit. Germany's economy has also been dwindling, and Italy's has essentially stopped. Asia's top economies are also floundering for a variety of reasons. Political protests in Hong Kong are adding to the economic damage inflicted by its trade war with the U.S., and Singapore is on the brink of a recession. Argentina recently experienced one of its worst stock market crashes in decades. And finally, Brazil and Mexico, two economic leaders in Central and South America, are expected to perform poorly this year. Add it all up, and the world's economic outlook appears somewhat grim. In June, the World Bank was already forecasting just 2.6% global growth for 2019, which is the weakest forecast in over 3 years. At a meeting just this month, they amended that forecast, saying that, we quote, "We now expect growth to be even weaker than that, hurt by Brexit, Europe's recession, and trade uncertainty," close quote. At the same time, the International Monetary Fund declared its most recent newsletter, quote, "The global economy is now in a synchronized slowdown." Specialists actually say that two major forces have caused and are driving the slowdown, and that neither shows any sign of going away anytime soon. The first, as you may have guessed, is the trade war that we currently are in with China. Some say that if President Trump and President Xi can reach a deal to end the trade war, the risk of global recession will drop considerably. Now, that was evident when the stock market spiked recently with the news that a partial deal was reached. Now, whether you agree with the policy or not, there's no denying that the escalation in tariffs since the trade war, since it actually began, has damaged one of the most important trade relationships in the world. These impacts go far beyond just the US and China's bilateral relationship. For example, Germany's economy relies heavily on exports, primarily to the US and China, and is now struggling to sell to those nations as their economies slow. Kristalina Georgieva of the International Monetary Fund warned that the trade war could cost the global economy up to $700 billion by the year 2020. Now, this is a loss equivalent to the size of the entire economy of Switzerland. The other major force behind this bleak outlook is the rise in political turmoil around the world. I already mentioned the protests in Hong Kong, but political battles in Britain, Brazil, and Italy have also caused long-term crises that are gridlocking economic policies and creating fear among investors. The ongoing battle over Brexit has had similar impacts across Europe as well. The U.S. has not been immune to this turmoil either. So far, the U.S. stock market has mostly been shrugging off political issues. However, other forces have created another recent increase in market volatility. What are they? And how do they factor into this global synchronized slowdown? We'll talk about that coming up in just a bit. Now it's time to bring in our next guest, Sam McElroy, great friend of the income generation and, of course, also a very close friend to your host here. He's a partner with At Financial and At Financial Investments in Chicago, Illinois. In addition to holding several financial licenses, Sam also has a doctorate in psychology. Sam, thanks so much for being back on the show.
Yeah, thanks for having me.
So, psychology, great. I'm going to put you down on the proverbial couch now. Actually, you're going to put the world down on the proverbial couch. And obviously, the 600-pound gorilla right now in the world economy that's getting all these economists to predict maybe a synchronized economic slowdown around the world, the biggest thing is this trade war. So if you can play psychologist for President Xi and President Trump and all the people behind them, what kind of resolution do you think we might actually see in the next few months?
Oh, Dave, we need hours upon hours to really dig into that. You know, it's such a fascinating question because in a sense, you have personal, I don't know what you want to say, personalities that are starting to shape policy. But in addition to that, you have collective cultures of countries in and of themselves. So in a sense, you have psyche upon psyche upon psyche. You know, if you think about where the resolution of all of the tariff talks are going to go, part of it has to deal with the fact that I believe both sides have become somewhat entrenched. And the question really becomes, even if progress could be made, how does either side make accommodations without losing face on the global scale?
And more importantly, without losing face politically in their own country, right? That's huge. Everyone wants to save face. So, okay, let's say that we don't get a deal done anytime soon, even a mini deal. Are you in agreement with a lot of economists that that means we will slide into global recession sometime in the next 18 months or so?
Yeah, I think it's an increasing likelihood that that's the direction that we're heading. I look at it kind of like the synergistic properties of anything that's going to start moving something really big in the same direction. So it's one thing when you have something happening domestically and you start to get a slowdown and you can utilize certain monetary policies or other things to try to pull yourself out. But to the degree that we're now intertwined on a global scale, if you have every player that's starting to slow down simultaneously, it creates this compounding effect where even if one could pull itself out, it's hard for all of them to pull themselves out simultaneously. And I think that may be what we're starting to see now.
How about this mini deal they're promising by the end of the year? If this mini deal goes through, do you think that'll really make a difference? Or do you think it's only going to matter if we have more substantive deals shortly thereafter?
I think it really depends on the way that we as consumers digest and interpret the information. I doubt anything substantive is really going to be able to come in the short term. It just seems like the two sides may be further away from each other to be able to really make that happen that quickly. So the question is, if something is done, is it going to be viewed as just the tip that's going to lead to something substantial that can happen in the future? Or are we going to look at it and say, you know what, this really isn't anything to really speak of. And in a sense, we're not going to let that change the trajectory of where we think these global economies are heading. And I have a feeling that it may be that latter, that we may look at the deal that gets done, and we may just say that it's not quite enough. And in a sense, if there isn't other supporting positive data that goes along with it, I don't know that it has the ability to then change the trajectory of where we're heading.
20 seconds we have left. We don't get a deal done. We do have global recession. We, as the United States, will we go into a lesser of a recession than many other parts of the world? And essentially, we have the upper hand. Your thoughts?
Yeah, I would agree with that. And I would say that in a sense, I think that there's a lot of stuff that has been going really strongly for the U.S. economy. At the same time, I don't know that that would necessarily save people that are overly dependent in the stock market, because I think regardless of the magnitude of the recession, the psychological impact of just us knowing that we're in a recession may actually end up pulling the markets down.
Good stock market pullback. Sure, we need to leave it there for now. We take a quick commercial break. Sorry about that. You stay with us. We'll be back here with more right here on the Income Generation in just a moment.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
The road to retirement is filled with twists and turns, and life's unexpected detours could easily throw you off course. That's why it's essential to work with a financial advisor who is also a fiduciary experienced in helping clients navigate the complexities of retirement planning while helping you pay yourself first. The road to retirement now made simple. To learn more, visit theretirementincomeStore.com.
Now, for the most part, September was another month of cautious stability for the U.S. stock market. However, that changed at the very end of the month when the Dow Jones Industrial Average dipped by some 900 points over the course of 2 days. This latest big swoon had little or nothing to do with the escalating impeachment turmoil on Capitol Hill. It was blamed primarily on a new report that the U.S. Manufacturing Index had posted its lowest reading in a decade in the month of September. After surging briefly in anticipation of the president's corporate tax cuts, both manufacturing activity and business investment began to slow in late 2018 and then started to decline even more in the second quarter of this year. The manufacturing index from the U.S. Institute for Supply Management dropped steadily over that same period until it contracted in both August and September. At that point, it actually hit a 10-year low of 47.8%. Now, while President Trump blamed the Federal Reserve for the decline, most economists blame the effects of the trade war. Again, whether or not you support the policy, its influence on the global economic picture is hard to dispute. It was at the World Economic Forum in Davos during 2018 that President Trump first announced plans that China with tariffs. Ever since that time, as the back and forth tariffs have escalated, global growth has weakened, falling from some 3.8% in 2017 to an expected 2.6% this year. Sectors such as manufacturing, which are highly exposed to global events, have been especially hit hard in some countries, pushing those economies close to recession. In more diverse economies like ours here in the United States, the blow has been cushioned thus far by a relatively strong jobs market and household spending. Now, some argue that this trend will continue, making it possible for this synchronized slowdown to avoid becoming a full-fledged global recession. In September, the U.S. unemployment rate fell to its lowest level in 50 years, and levels in the UK are at a 45-year low. On October 4th, Federal Reserve Chairman Jerome Powell declared that the U.S. economy is, quote, in a good place, and noted that people from low and moderate income communities are still comfortable, they're spending money, and they're optimistic about new job opportunities. All of this makes Powell and some others confident that consumers might just continue to spend, might continue to fuel U.S. growth, even as businesses pull back on investment, even as manufacturing slows, and other effects of the trade war ripple through the economy. Now, despite this stated optimism, it hasn't stopped Powell and the Fed from reversing their plan to continue raising short-term interest rates this year and then lowering them again, most recently at their September meeting. Though they've rejected President Trump's calls to drop rates all the way into negative territory, they have reduced the benchmark Fed funds rates to a range of 1.75 to 2%, after having started the year at 2.5%. Powell has described the reductions as insurance against the ongoing trade uncertainty, and the European Central Bank has also loosened policy again in response to the synchronized slowdown. Now, naturally, optimists here could be right. It could be that a combination of healthy spending and crafty artificial manipulation by the Fed and other central banks might just be enough to offset the impact of the synchronized slowdown. It could be that things will start to get better soon for the global economy before they get much worse, and that in spite of the trade war, in spite of political turmoil and a host of warning signs, things might actually improve. Now, I'm sure we all hope that's the case, but the question becomes for you, what if it isn't? What if a global recession really is on the horizon? Are the Fed and other central banks really prepared to handle it? Will they have enough ammunition left after a full decade of leaning heavily on loose policy and artificial stimulus? We'll talk more about that coming up in just a bit, and about another concerning issue involving the Fed that hasn't gotten much attention yet, but could be extremely relevant to the global economy. Now let's bring back in my good friend, our good friend of the income generation, Sam McElroy, partner with At Financial and At Financial Investments in Chicago, Illinois. Sam, thanks for sticking around.
Absolutely.
Let's switch subjects now because, everyone's tired of talking about the whole trade war. We've been talking about it for the last year and a half, maybe a year and a half from now. We might still be talking about it. What other things do you see economically worldwide that concern you, that point to recession? Not just here in the United States, but across the globe.
I think there's a couple of things that I'm really looking at. There was some information that came out recently by some of the global central banks that was suggesting that if you look at some of the markets like the United States and Japan, that they feel that the market or the equity market may be a little bit overvalued. And at the same time, they're talking about the spread between interest rates being too low, which is nothing new. We've been watching this for a while. But if we look at what other countries, other nations have been willing to do in terms of how low they would reduce their interest rates, even going into negative interest rate policies, I think all of that is really starting to concern me as well. Not to mention just some of the political unrest that we're starting to see that can act as a market disruptor many places throughout the world.
How about us? Do you think we'll see negative interest rates down the road if we wait long enough?
Dave, it's one of the things I'm really watching. In a sense, I feel like there's been other points in history where we had laid the groundwork and if we had to, we were going to go that way, but we really did everything we could to not have to do it. I think in a sense, charging someone to keep money in the bank just seems like an oxymoron to me. I'm still trying to kind of wrap my head around it. But one of the things we saw, especially with the 2 interest rate decreases this year, is that the market and many people that are on the committee for the Fed didn't think it was enough, which means that I feel that there's a growing movement out there that may be okay with us going into negative interest rate policies. And if that is the case, then if we have to, we may do it, because I think that we've kind of prematurely used some of our ability to use interest rate policy to try to stave off the recession. So if it happens, you may see it.
So let's say we do get a mini deal done on the China trade war. And in that case, maybe that's not quite enough to keep us out of a recession. Can the Fed do something then, in your opinion, to actually avoid recession? Or do you think at this point they're for the most part out of ammunition?
Yeah, I think that by lowering interest rates at the points where they did, they may have started to prematurely use some of that ammunition. We go back to where we were at the last start of the recession, and we know that interest rates were much higher than where we are right now. So the ability to be able to utilize that type of monetary policy to try to pull us back out of an economy and stimulate some economic growth, I don't know if it's going to have the same impact this time if we try to do it.
Now, as it turns out, the World Economic Forum happens to agree. They said that we are less equipped now. The Federal Reserve is less equipped today, as well as other central banks, to deal with a recession of sorts than they were back in 2008. So most importantly, the 1 minute we have left, what can our viewers, our income generation members, best do to be highly equipped for the next business recession?
Yeah, I think one of the things that's so critical is that obviously nobody has a crystal ball, and so it's not about trying to guess or cross your fingers and speculate and hope that you get it right. I think the biggest thing is that you have to start to separate your capacity to generate income from being reliant on having market growth. And if you can do that, then it puts you in a position to make sure that you continue to cash flow positively, good, bad, or indifferent, regardless of where the economy goes.
So protect yourself. You don't have to play the stock market game. It's your choice as an investor if you choose to play it. And if you're retired or within 10 years of retirement, you should have already started making that transition from the G to the I anyway, in which case all this becomes a moot point if they're your clients and you've prepared them the way I know that you do for retirement. So, CM, thanks so much for being on the show once again. We appreciate it.
Yep, thanks for having me, Dave.
Stay with us. We'll be right back here in a moment on The Income Generation. I'm David Scranton, and we'll be right back.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved. It's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
Now, as regular viewers know, I have often used steroids as an analogy for quantitative easing and for other forms of artificial economic stimulus, which have become extremely prevalent in the global economy since the financial crisis. I believe it's a fitting comparison for many reasons. One, being that steroids mask reality. When an athlete's performance is enhanced by steroids, it becomes impossible to know what he might be capable of without their influence. And the same can be said of the financial markets. From 2009 to 2019, the stock market has grown by more than 300% from its low point during the crisis. It also has managed to avoid, so far, a third major market correction, which historic evidence suggests should have started around 2013. Now, throughout this time, the Federal Reserve has engaged in unprecedented levels of artificial stimulus and market manipulation at the same time, including 3 rounds of quantitative easing. Other central banks around the world have followed our bad example, adopting similar policies and similar practices of their own. In other words, the stock market and the global economy overall has been like an athlete on steroids these past 10 years, making it impossible to know its true strength or its true health apart from all of this stimulus. Another reason I believe the steroid analogy is so fitting is that not only do steroids mask reality, but their effectiveness decreases with overuse. That's true of any artificial stimulant. The more you take, the higher the dose you need over time to achieve the same results. It becomes a vicious cycle of diminishing returns, and it's what makes steroids and other stimulants dangerously addictive. Well, after 10 years of addiction to quantitative easing and the possibility of a new global recession looming, many are worried about all these potential consequences that I've been warning about from the very beginning. Just recently, heads of World Economic Forum warned that the world is much less prepared for a global economic shock than it was back in 2018 when the financial crisis struck. They gave several reasons, one being that central banks may have used up most of their options to stimulate growth already. Monetary policy may have run out of steam, and some countries are facing a liquidity trap. And this is a quote from the WEF, including the following. Furthermore, the geopolitical context is more challenging now than in 2007, with gridlock in the international government system and escalating trade and geopolitical tensions fueling uncertainty, which holds back investments and increases the risk of shocks. Now, as we discussed before, bleak forecasts like those of the International Monetary Fund and the World Bank could prove to be overly pessimistic. It's possible that strong job markets and robust spending here in the U.S. and some of the other major economies could be enough to curtail growing impacts from the trade war and from other negative forces. It's possible the global economy will exceed 2.6% growth this year and never drop below 2%. 2% is the borderline where we officially signal a global recession. However, if that more optimistic scenario doesn't pan out, it's important to be aware that the ability of policymakers to combat a new recession and to get the economy back on track this time may be seriously compromised. Through overuse and short-sightedness, I believe, the Fed and other central banks may have seriously weakened their own ability to perform one of their primary functions, much like an athlete who's abused steroids and must now perform without them for the first time. That's especially concerning if the next recession is anything like the last one. Now, although few specialists are forecasting such a thing right now, keep in mind that most never saw the financial crisis coming until it was too late. But warning signs of the crisis were in place. So is another one in place right now? We'll talk about that coming up in just a bit. Now it's time to bring in our next guest, Michael Eastham, founder of Fellowship Financial Group in Altamont Springs, Florida. He's also the author of the book, Common Sense Income Strategies, and a good friend of the income generation. And yes, once again, a very good friend of your host right here. Michael, thanks for joining us once again here on the Income Generation.
It's great to be here, Dave.
Okay, we're talking about international economies. And of course, our whole show today is about how we have this synchronized slowdown globally. And it's being blamed heavily on the U.S.-China trade war. So what do you think? We get this mini deal done by the end of the year like the president's attempting to do. Still isn't signed, sealed, and delivered. We get the mini deal by the end of the year. Does that give us really a chance of fending off a global recession? Or do you think that we're too far beyond the power curve at this point?
Well, I think it could temporarily stave things off. Look, if we have parity between the United States and China, then that gives both sides the opportunity to trade fairly. Up to this point, it certainly hasn't been, and I think the Trump administration has done, at least fighting very hard to try and straighten that parity out. So I think it could certainly push it off for a certain degree, but I think ultimately we're going to see some slowdown, whether that's 2020 or 2021, I just don't know.
Okay. Now, let's say that doesn't happen. The deal doesn't get done. A lot of people are skeptical right now. Some people that are behind President Xi are actually saying, they want more, that's too favorable a deal for the United States. Now, what does that mean? Does that mean next 12 months maybe we're seeing global recession?
Well, you've got skeletons in the closet all over the place. It's just a matter of when are those skeletons gonna drop. I mean, when you look at the United States, I kind of talk about the U.S. as being the cleanest dirty shirt in the laundry basket, and that simply means that we still have our own issues. It's just, just look at the yield curve. The yield curve itself, historically, when it's inverted, then that tends to lead directly to recession. That hasn't happened so far, and we're certainly dabbling in that environment. So it just really depends. I certainly think that because the economy here is so strong right now, I think that that certainly creates some momentum for continued economic growth and into 2020. But who knows? With the volatile political climate that we're dealing with, especially over the next 12 months, anything could happen.
So what else then, outside the trade war? What other things do you look to globally, not geopolitical per se, but other economic things globally do you look to that really cause you to pause and say, you know what, we are heading off the precipice into some sort of recession coming up, at least in the next 18 months?
Well, I mean, manufacturing slowdowns could certainly be a triggering event. Certainly, the consumer spending is going to be a significant event. You start to see significant increases in debt, and we are actually seeing increases in consumer debt right now. So any one of those things, and certainly other things, could make that happen sooner rather than later. And our
economy's doing better than most other economies globally, right, due to consumer spending. But yet a lot of these other economies are actually in negative interest rate environments right now. They've tried so hard to stimulate things, they've got things in the red, and still we're faring a little better than them. So I get that clean as dirty shirt in the economic hamper thing. We have 45 seconds left in this block. How about the inversion with interest rates between some countries such as Italy that arguably have more risk to their debt, but yet the interest rates on their debt is the same, if not less than ours? It doesn't make sense. The things aren't priced right internationally. Does that scare you at all? And if so, why?
Well, it doesn't make sense, but it hasn't made sense for a long time now. We've looked at that same issue for several years at this point. At first, it was a huge concern to me. It's still a very big concern because you're right. There's no parity economically between countries like that are less stable than we are versus the United States, which is much more stable. So that's a major concern. That tells me that there needs to be a correction at some point. I guess what I've given up doing is trying to polish the crystal ball and look for the answers. It's just a matter of trying to be prepared and ready for that next step.
Smart man. I love it, Michael. We need to take a quick commercial break. We'll be back in a minute. Stay with us. We'll be back right here on the Income Generation. Just a moment.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently some fixed income investments have actually outperformed stocks. But yet, you're still waiting to act. Visit the retirementincomestore.com today to regain control of your retirement.
Oftentimes, an iceberg doesn't look that dangerous to an approaching ship. Why? Because its real danger is hidden beneath the surface of the water. That's sort of what happened in 2008 with the financial crisis. We knew months in advance that the subprime mortgage crisis was looming, but many predicted it would be little more than a bump in the road for the economy. What we didn't really know or come to appreciate until later was how the banks had all tied themselves together with these instruments called credit default swaps. They had all reinsured one another so that once one bank began to fail, they all came down like a bunch of dominoes. Now, I mention this because a recent incident involving the banking system in something called repurchase agreements, known as repos, had some pundits seeing parallels to 2008. In September 16th, banks experienced an overnight liquidity crunch in which they suddenly didn't have enough cash on hand to meet customer needs for loans and withdrawals. And this is just September 16th this year. As a result, the Fed funds rate momentarily spiked to 10%. And the Fed had to step in and immediately pump cash into the banking system, pledging to allow roughly 2 weeks of overnight repo transactions, each injecting around $75 billion daily into the economy. Now, near the end of those 2 weeks, the Fed announced that it would extend the policy through January of next year, and also began buying up Treasury bills at an initial pace of about $60 billion, and to continue the buying at least into the second quarter of 2020. Now, while the Fed insists all this doesn't constitute more quantitative easing or more steroids, it does. The truth is that, and in fact, the unsettling part of it all, is that no one really has a good explanation for how all this happened. Several theories have been posed, but all of them, I believe, are flawed. Ultimately, it seems like somebody probably does know exactly what caused this so-called liquidity crunch in the banks, but isn't talking about it. As a financial advisor, that concerns me. Why? Because again, the situation feels eerily familiar. Is it possible this liquidity emergency is evidence that banks have somehow tied themselves together once again in some way? Maybe this time with an interest rate swap, for example? It seems unlikely to me that a majority of banks all on the same day would have suddenly run out of cash at the same time. It seems more likely that the crunch would have started with just a few banks, but then began to impact the entire system due to some sort of underlying connection that we may not yet be aware of. If that's the case, could this incident be early evidence that another financial crisis of some type is brewing? Well, no one knows for sure. But with the entire global economy already in a synchronized slowdown, and the third major correction of our current secular bear market cycle long overdue, I believe that investors should at least be aware of it, especially those of you in or nearing retirement who haven't yet reduced your risk in the stock market. Maybe last month's liquidity emergency was just a financial fluke, or maybe, just maybe, it was the tip of the iceberg. Now let's bring back in Michael Eastham, founder of Fellowship Financial Group in the Orlando area right here in Florida. Michael, thanks for sticking around for this last segment.
My pleasure.
The Federal Reserve, what should they do, in your opinion, to give them the best chance of fending off or minimizing any future recession in the next 24 months?
Well, I think they've started doing it. It's been interesting over the last year or so since, really since they did finally realize, hey, we pushed the rates up as high as they can go. Now we have to settle them back down again. I think that was the biggest reason why they actually raised short-term rates to begin with, so that they had a little bit more leverage. I don't think the Fed wants to print more money, but if they continue to push things down too far, they may end up having to do it to maintain some balance in the economy. So I do think we're going to see some reductions in short-term rates over the next 12 months again. But again, I think it was all part of the Fed's strategy to begin with.
So, it's interesting. According to the World Economic Forum, the Fed is less equipped today than it was in 2008 to deal with another recession or another financial crisis. So, in the 1 minute we have left here today on the show, tell our income generation members what they can do to best protect themselves in case of another recession.
Well, I think that's a great point. Part of the problem is that the Fed has, the federal government printed $4 trillion worth of money back in the last recession, the big financial correction. So the best thing that people can do to prepare themselves is to make sure that they're being careful with their money, that they're working hard to reallocate their principal and their investments more on the conservative side of the spectrum for income and for reasonable income generation, whether it's interest, dividends, or predictable income streams where you do have some guarantees. So those are the types of things that we're talking to our clients about as they prepare for stepping across the threshold into retirement, or if they're just conservative and concerned about what could happen in the global economy and how it might affect their retirement. Nobody wants to go through 2008 again, so we just want them to be best prepared to do that.
If you want to play the stock market game, it's a choice. It's not mandatory. So, Michael, thanks so much for your time. We really appreciate it.
It's my pleasure.
All right, we'll be right back here in a moment on The Income Generation. I'm David Scranton, and we'll be right back. Now it's time to bring in Newsmax TV host John Bachman, the host of the Newsmax Now show, which you can watch every night starting at 6 p.m. Eastern. John, thanks for joining us today.
David, my pleasure. And kind of role reversal here, right? I usually interview you, but I'm happy to be on Income Generation.
I know,
today.
this is going to be fun. I love it. So, okay, I'm glad to have you here because, I'm trying to figure out from a financial standpoint how certain geopolitical events could affect the markets. But to me, my knowledge really extends just from the tweets that I see from day to day from the president. So let's start with the trade war. From what you're hearing, the people that pay more attention to it than I do, that you're interviewing, is it likely that we're going to get this mini resolution done before the end of the year?
I think it's going to be difficult, quite honestly, David, because there are a couple factors playing into this that are completely beyond President Trump's control. Number one, if you do a deep dive into the Chinese economy, there are new reports out now that China and Communist China and the Communist Party is in terrible trouble when it comes to their amount of debt load. This has also placed President Xi in a difficult position now. Even though we saw this big spectacle last year where he was exalted almost to the level of Mao Zedong, it is unclear how much clout President Xi actually has inside the communist government in China right now to get a deal done. So when you hear President Trump talking about the Chinese agreeing to buy agricultural products and things like that, and you see President Trump being effusive to President Xi, it's partly due to the fact, at least based on what I'm hearing from reporting, that President Trump is almost propping up President Xi a little bit, so hopefully they can get a deal done. Now, the other factor that's weighing into all this as well is the upcoming U.S. election. There are obviously factions within the communist government of China that don't want to do a trade deal with the United States government. They think they might actually get a more favorable deal if they wait and get somebody else other than President Trump. So those are the two things that I think might be obstacles to actually getting a trade deal done. Now, President Trump wants to get something done. It seems like President Xi wants to get something done, but the other factors involved may prevent them from getting something done.
So it almost puts pressure on to get a mini deal done this year, because if it doesn't get done this year, now it's almost as if they can say, well, let's kick that can down the road because November is not that far away. Isn't that the case?
Right. Well, yeah, I mean, we're 1 month away, obviously, from being within a year of the election. You heard President Trump talking about the kind of framework for this new deal being released 4 or 5 months from now. So just think about that. We will be in the middle of campaign election season. President Trump will have plenty on his plate just to get reelected. So you can imagine how difficult it would be at that point to get something done.
John, 20 seconds. How much of this do you think has to do with the issue of intellectual property theft?
Well, that's a big issue, and it's one of the difficult things to talk about. And if you realize that you look in kind of read between the lines, they talk about technology transfer. That's what they're talking about with intellectual property. This might be the biggest obstacle, David, to getting a deal done.
John, we need to leave it there for now. You're actually pretty good at this television stuff. We might have to invite you back sometime in the future. Thanks for being here, John.
My pleasure, David. Great to see you.
You stay with us also. We'll be right back with more right here on the Income Generation. I'd like to thank all of our guests for joining us today for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. There's no getting around it. We live in challenging times. With the world more interconnected now than ever before, technologically, socially, economically, problems in one country or region can potentially cause problems virtually everywhere. And that's important to keep in mind as you consider your own financial future and the question of risk. Yes, the stock market has risen impressively since the end of the Great Recession. And so far, it's avoided another major sustained market drop. However, it's also been in a nervous holding pattern for almost 2 years now as the global economy has slowed and as fears of a new recession have increased. Keep in mind also that much of the market's performance since the financial crisis has been aided by unprecedented levels of quantitative easing and other forms of artificial stimulus by our own Federal Reserve, as well as other central banks around the world. So much so that many are concerned that policymakers may have played all their cards, leaving them ill-prepared to deal with the next big crisis when it hits, or even a minor crisis for that matter. Remember, sometimes the extent of a looming problem isn't obvious until it's too late, as we learned in 2008 when the failure of one major bank almost brought down our entire financial system and essentially caused the financial crisis. It was like hitting an iceberg, and now some believe a recent problem in the banking system could be the tip of another iceberg. As I often say, no one has a crystal ball, and forecasts always vary. Some believe the global economy's current synchronized slowdown will improve before it gets worse. regardless of what happens with the trade war and all political battles underway. And those folks could be right. But the most important thing to remember as you think about all this in relationship to your own money and your own financial future is that the key to increasing your retirement income actually lies in reducing your risk. That starts by shifting your strategic focus from investing for growth to investing for income, with the help of a financial advisor who specializes in income-based strategies. Once again, thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.